Imagine working a month of long shifts only to see a $2,000 paycheck shrink before it even clears. When the notification finally hits your phone, only $1,456 actually makes it into your balance. Taxes represent the inescapable cost of a functioning civilization. This mandatory deduction funds the infrastructure we use every day, from highways and bridges to public schools and national defense. Most of us intuitively believe the remaining cash is placed for safekeeping inside a physical room, protected by steel doors and armed guards. Banks act as financial matchmakers, moving currency, which is essentially a social construct built on trust, directly from your account into the hands of a borrower. The second your money is deposited, it is already gone, used as the fuel for a chain reaction that drives the global economy. This is fractional reserve banking. Banks hold a small sliver of your cash, often 10%, and lend out the other 90%. You provide the supply of money, while a borrower buying a jet ski represents the demand. Because the bank doesn't actually have your money in a vault, the entire structure relies on the assumption that everyone won't show up at the exact same time to withdraw their balances. Even while you sleep, your savings are actively taking risks in the world, generating interest and profits for the bank. To decide who is safe enough to receive your deposited funds, lenders rely on a shadowy algorithm. A credit score measures a borrower's adult credibility on a scale from 300 to 850. This single three-digit number dictates whether you are approved for a mortgage or forced into a high-interest loan. If the algorithm approves the loan, the borrower must pay interest, the rent charged for the privilege of using someone else's cash. Interest has two faces. When you invest, compounding interest acts as a wealth multiplier. When you carry credit card debt, it becomes a financial time bomb. Interest is the silent engine behind both massive fortunes and systemic poverty, and the outcome depends entirely on who is collecting the check. Banks constantly lend the same dollars over and over, hitting the market with a flood of cash. Eventually, too many dollars chase too few goods. This is inflation. The dollar bill in your pocket stays the same, but its purchasing power shrinks as the prices of goods rise. While official reports often cite inflation at 2 to 4%, the real cost of major expenses like housing, healthcare, and education is climbing by 8 to 10% every year. Storing your money in a traditional bank account guarantees a loss in value. You are effectively paying an invisible tax every day your capital sits idle. To fight runaway inflation, the government raises interest rates, making it more expensive for people and businesses to borrow money. As the cost of debt rises, consumer spending halts. Businesses respond by cutting costs and laying off workers to survive the sudden drop in demand. The economy shrinks, the stock market drops, and a recession takes hold. These painful resets are a predictable part of the economic cycle, clearing out excess debt so the next phase of growth can begin. To outpace inflation, you must move beyond saving and begin investing your capital in productive assets. Investing requires you to watch your portfolio drop during these inevitable economic resets. To most people, this feels like a punishment for making a mistake. Successful investors view this market volatility as a mandatory admission fee for long-term gains, paid in the currency of fear and doubt. Staying in the game allows you to capture tail events, those rare breakout wins that generate the vast majority of historical wealth. Warren Buffett has held hundreds of stocks over his career, yet almost all of his wealth came from just a handful of quiet, compounding companies that he refused to sell. The financial system is designed to siphon value from those who don't understand the rules, but it geometrically rewards those who stay disciplined and patient.